I'm pleased to report that the firm is going very much in the positive direction I wanted to do when I spoke last time. The new executive team, along with some of the existing executive team, have only been in place for actually a few months. But during that period of time, along with the team leaders, and I'd like to congratulate them all, they've worked extremely hard on what we set out to do, and that's to get the firm in a much better position so that it can really benefit from a more robust position in the second half and our aim to return to profitability. Looking at the financial highlights for the first half, the most important and pleasing figure for me is a 55% drop in operating loss for that period. Now, we've seen market conditions the worst anyone in this industry has seen for some time, and they haven't got any better. But despite that, we saw revenues fall by just 11%, but our programme of cutting costs has been more successful than we anticipated, and we've cut costs by over 17% in that period. In the cost-cutting programme, one of the essential things was to get the firm off duplicate platforms and the associated costs that go with having to maintain those platforms. This has been extremely successfully handled across the firm, and we anticipate the exit from all duplicate platforms before the end of our financial year end. This will, of course, have a net effect of lowering our costs as we won't be paying for them, but also the support that goes as a function of looking after those systems. Turning to the wealth management business and its performance over the first 6 months, one of the key things, as already mentioned in cost cutting, is the removal of the duplicate platforms. Also, the repricing programme is well underway and is going extremely well. Although assets under management during the period fell by just 8%, that's largely reflective of the challenging market conditions that we're seeing across the businesses. Importantly, the discretionary fund management proportion grew to 48% from 46% during the same period, and that's important because that's a key area where we want the business to grow. If we look at corporate and institutional broking for the first 6 months, there's no doubt that these have been the most challenging market conditions that anyone in the industry has seen, and that's affected us as long as everyone else. However, I'm pleased to report in that period that we've gained 7 new corporate clients, and we've done over 30 transactions. Now, a number of those transactions are in the private equity space, and that's aligned with our investor forum, where we've now have 129 high net worth and family offices as part of that investor group, and we're looking to grow that all the time. In addition to those successes in the first 6 months, we've still been building the team while keeping a strong control on costs. We've added some new senior personnel who've joined the firm very recently, and we will see the benefits of that in the second half. Also today, you will see that we've separately announced some further changes to the board. Importantly, this now gives us a complete board with the addition of Phil Shelley, who's got a very extensive corporate broking background, Simon Locke, who joined earlier in the year, who has extensive wealth management background. We're pleased that we have Victoria Raffay still on the board with her extensive regulatory background, and Alistair Buchanan, our latest addition with an extensive corporate broking and audit background. This now gives us the governance we need for the firm to be in a very robust place to take it forward. Also today, you will see an announcement that we're looking to raise up to £3 million in additional funds. This will be done by an accelerated book build and subject to a general meeting. The reason for this was it will continue to strengthen our capital base. It will put our capital ratio at 158%, which is extremely healthy, and will see us way through to our return to profitability, which we still anticipate to be before the end of year end. It also puts us in a very strong position compared to some of our competition for us to now grow the business and to help us through what remains difficult market conditions. So for the outlook for the second half, we've anticipated that markets can get no better, just to be conservative. Of course, we hope that's not going to be the case. But despite that, our estimates are that we should be able to return to run rate profitability by the end of our financial year, despite those market conditions remaining challenging. The key elements of the second half to get us to that run rate profitability is we continue to focus on costs, how we can further improve the business, its efficiency, and cut costs wherever it's applicable without damaging the offering to clients. At the same time, as we've mentioned before, we're looking at revenue enhancing ideas in both wealth management through the repricing and expansion, and through corporate broking through the new staff that we mentioned earlier. So in conclusion, after being here for just over a year, I've seen an enormous turnaround in the business, and one that I'm very pleased with. I'm also extremely grateful to the colleagues, both new and existing, that have helped this turnaround happen. What I see now is a very bright future for WHIreland, taking us towards the end of this financial year and our ability to grow and expand the business and return to profitability.